Hi, I'm Peter Rose, founder of Longwood Currency Trading. Trade entry, slip in reverse, an option that I use very infrequently. And I'd just like to discuss it because in chatting and a couple of emails that I've had the last week or so, a lot of the conversation has to do with entry and what happens when it doesn't work, when you get the entry the wrong way. The slip in reverse simply means that you've chosen an entry level. Let's say you were going long. You entered long, and what happens is that the price turns around from going long and sweeps in the other direction, and you gotta get a stop there that's going to get hit, and it gets taken out, and you're done. So normally in the videos that I've said, well, what you do then is you wait, because a lot of times what happens is the price will turn around and go back to where it was and then proceed on from there. You do some basic entry analysis to make sure everything is okay, and then off you go, and you're back into the trade. Many times what will happen is it'll hit that stop and it'll keep going. So now you would consider possibly waiting longer. Say, well, I got this wrong, it's going to continue down for 20 or 30 pips, and then it'll turn around and it'll go back up, or I'm not interested in taking that trade. That's more often what I do because I'm a short bias trader. I tend not to trade on the long side because of certain characteristics of what I do and how I understand how the market functions. And regardless of that, I'm just not going to trade on the long side. However, if I am trading on the long side, I would tend to use this because of that short bias. So I'm in the long trade. It comes back against me, takes me out of my position. Let's call that 10 pips. So I've lost 10 pips on whatever size I'm trading. So now I'm waiting and I'm looking at that thing. When I do my initial trade entry analysis, I'm looking at making sure that my stop is far away from some order congestion area. If it isn't, if my stop is, let's say there's a lot of order congestion here where most folks would set their stop, I don't set my stop that way. I have a static position where I set my stop, boom, that's it. And then I don't care what it does. I'm out. But if I set that stop too close to where that order congestion was, that order congestion would tend to suck it down. There's a lot of stop hunting that goes on, or price hunting that goes on. They'll pop up their orders, grab it, and it continues on down. So it's just not something that I advise folks doing. So in my particular way that I trade, the fact that that triggers doesn't necessarily mean that it's going to go down to that order congestion area where I would normally get at, where most folks would get out, because that's where the order congestion is, and that's where you're going to get stopped out, right? Anyway. So it could go back up. But in this case, it goes down, and it goes not only into that congestion of previous order flow, but it goes beyond that. So it's going down. So it's hit my stop, it's going down, it's past some structural configuration area. I'm going to do a new entry analysis, but this time I'm going to do it on the short side because it's gone past that congestion area. Now, let's not confuse a congestion area with a boundary condition of a range, because those are two totally different things. I've got price moving now on a short side direction where I had got out because I was in a long trade. I've lost 10 pips. I go back in, but this time I go short. Now I may go back in with whatever value it was that I had in my entry lot size that I went in with. Maybe I went in with 3 lots, maybe I went in with 10, it doesn't really make any difference. But whatever lot size I carried to my stop, I have the option of either entering my new short position with that same size or reducing that. So let's say I came in with a 5 lot, I lost a 5 lot. Maybe on my entry on the short side, I'll go to 3 lots to mitigate the fact that maybe that price is just farting around down there and going to the lower range of perhaps where that order flow congestion area is, and then it's going to turn around and go back in the other direction. That's part of your entry analysis that you're going to do, and it has to do with the rules that you have. And it's only applicable if you're building positions and then staging and all that other kind of crap where you would make that kind of split lot decision. Let's just say, for argument's sake, that you're all in, all out trader. I've lost 10 pips on a 2 lot, and now I've entered a short position on another 2 lot. That's the slip in reverse. The slip was when I slipped out of the trade, which would normally just be a closeout. But if I'm going back in now, then what I've done is I've slipped out of that bad trade, and I've done my reverse by reversing the position. That's where the term, my term, okay, slip in reverse. And by the way, I get that out of martial arts and out of karate, because usually what we're doing is we don't really have any blocks. They're strikes. So if you're punching at me from this side, you know, that's going to be a block, and that's going to be a strike on that. But what happens many times is that I'll slip the strike on the block and reverse and go in the other direction. So here's my first strike, here's my second strike, and then there's a strike up to the throat. So it goes bang, like that. And that's where I got this this technique to call that the slip and reverse in trading. There's a caveat that goes with that. It's deadly, because in a best case scenario, if the reverse doesn't work and then you stop out, where do you stop? Do you stop 10 pips, which is what your other one was? Do you set it at the staging boundary condition? I mean, that's why the rules that I have are very flexible, because you could look at the price action situation that's going on right then, and you can make those kinds of determination in real time. You can't learn that stuff from a video. You can't learn it from somebody who does a course and you just read this stuff. You have to have some consulting. If you don't know what you're doing, or you're not good enough to do that kind of thing, then you better ask some questions. You better get some consulting from somebody who knows what they're doing and can advise you as to how to build your rules around that particular slip and reverse kind of situation that you're going to be encountering. So just to recap the slip and reverse, I've taken a position long, it goes against me, and I tap out at my stop. Let's just call it 10 pips. I went in with 2 lots, I stopped out with 2 lots. The position continues to go short on me, and I make a determination based on some conditions that I've set in my rule that says if this happens, or this happens, or this happens, or if this happens and this happens and this happens, then slip and reverse and go into that trade and go in the opposite direction. That's a summary of it. Now let me tell you my sad story. Because I have this bias and I don't use this very often, and when I have used it, more than 50% of the time, I've lost that next entry. I've got the timing wrong on it. Only a few times when I've done that has that thing run and gone on. And I've made, I'll make 1.5%, 2% on the trade, maybe 3%, 4%. Again, my issue in cautioning you not to do this is because as human beings we have more of a fear of loss than we have a want for gain. And so when we're in a position that's moving in our favor, we tend to get out too soon. But when we have a position that's moving against us, we tend to let it run. And so if you get the thought of the slip and reverse technique in your head, the decision is where do you get in? And if it looks like a slip and reverse, and this is just because of my real estate background, I extrapolate forward and say, oh, this is going to be a slipping, but this is not a slip and reverse situation. This thing is going to actually turn around. So I don't get out at my stop. And I let the thing go. And then the thing has gone so far that I go, well, at some point it's got to turn around because, and then I list off all the stupid shit reasons why it should turn around, and it doesn't. And then it goes 200 or 300 or 400 pips against me, and more that I've had. I've gone to margin call on that at one point. So you have to be really careful because that's a widow killer. That's more than losing 2 times your entry bet. It could be your account. And so I don't really teach that. I don't really advise it. But if you're going along trading on your own and you get this brilliant idea, oh wow, you know, I was wrong going that way, so maybe I'll be right if it goes the other way. If you really don't understand all the ramifications of that and what could potentially happen to you, is you better do some really strong thinking before you try to do a slip in reverse. That's all I want to say. Okay? All right. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.